Special Report, Sharpe Ratio, a deep dive updated, July 2026. If you would prefer to view this post as an audiovisual file, please use the link provided with this post. The latest dashboard update shows a further strengthening in risk-adjusted performance. Annual growth rate is now plus 27.7%. Net asset value return is plus 96.2%. The live gain line is plus 103.8%. And the Rolling Sharpe Ratio is approximately 4.6. The previous Sharpe Ratio report showed Rolling Sharpe around 3.9, after a recent high near 5.4. The key point is not that Sharpe stays fixed. Sharpe is dynamic. It rises when return is strong relative to volatility, and it compresses when market conditions become less efficient. A Rolling Sharpe Ratio near 4.6 is a strong reading, but it should be interpreted carefully. It does not mean the strategy is risk-free. It means that, over the measured rolling period, the strategy has generated a high level of return for each unit of volatility taken. The dashboard suggests that recent gains have not been achieved through uncontrolled instability. Return has improved while the broader drawdown profile has remained contained. This matters because headline return can be misleading in isolation. Two strategies can both deliver strong cumulative gains, but one may require deep swings while the other compounds with greater efficiency. Sharpe Ratio helps separate return from return quality. For investors, that matters because the easier a strategy is to hold through weaker periods, the greater the chance that reported returns become captured returns. The strategy is not based on forecasting the next market move. Its Sharpe profile is supported by a repeatable process, momentum-led selection, systematic rotation, multi-horizon ranking, diversified construction, and monthly rebalancing discipline. These elements keep exposure aligned with relative strength while reducing exposure where leadership weakens. The Nasdaq 100 backdrop remains constructive but uneven. AI infrastructure, semiconductors, memory, cloud, cybersecurity, and enterprise technology remain the main leadership themes. However, recent market action has highlighted the fragility that can emerge when leadership becomes crowded. Late June trading saw sharp weakness in chip and AI-linked stocks, as investors questioned valuation, interest rate expectations, and the scale of AI capital expenditure. The outlook for the months ahead remains positive, but risk-aware. Structural technology themes remain intact, particularly AI deployment, semiconductor capacity, memory demand, cloud infrastructure, cybersecurity, and automation. At the same time, the market is likely to remain sensitive to earnings guidance, Federal Reserve messaging, bond yields, inflation data, and evidence that AI-related spending can convert into visible revenue and profit. The key takeaway is this. The latest dashboard shows a strategy that continues to compound with meaningful risk-adjusted efficiency. The Rolling Sharpe Ratio of approximately 4.6 is not a guarantee of future performance, but it is a constructive signal that recent returns have been generated efficiently relative to volatility. The important feature is the ongoing evidence that the process can rotate, manage exposure, and compound within a disciplined framework. Current or recent example holdings include ARM, MRVL, MU, AMD, and WDC. These holdings are examples of current or recent exposure. They are not recommendations. Positions may change as the model updates. For readers who would like to explore the strategy, methodology, and supporting market analysis in more detail, additional content is available at Backseat Trader, at www.backseattrader.com http://www.backseattrader.com. For an audio-visual version of this update and previous posts, please visit the Strategy Commentary archive. You can also view our video content on the Backseat Trader YouTube channel. Past performance is not indicative of future results. Investing involves risk, including possible loss of capital.